And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Tuesday as we head into earnings season. Yes, earnings season actually starts this week. Talk a little bit of something a little different this morning than just, tariff. But we'll get to tariffs too. We're going to talk about that as well. Lots of stuff going on there. But we do start earnings week this week. We're going to start seeing the banks come in reporting. By Friday, we'll get JP Morgan, kind of the big major banks. Then getting into next week, we'll get into really kind of the heart of earnings announcements. The thing to be paying attention to, and that is not the earnings numbers themselves, because they're kind of irrelevant at this moment. Whatever was happening in the first quarter is behind us. And this was before all this tariff stuff. So again, the markets are going to pretty much just look right past whatever the earnings numbers were in the first quarter, unless they were really bad or really, really good. But they're going to really focus on what the CEO says about the outlook now because of tariffs and what to expect over the course of this year. Of course, CEO confidence is dropping pretty sharply here because of these tariffs, the impact of tariffs on the economy. They realize that that's going to impact their business model. Consumers, it was interesting yesterday, consumer credit came out yesterday, a slight decline in the amount of consumer credit, which was very unexpected. Immediately, a lot of headlines came out yesterday. It's like, oh my gosh, consumer credit contracts, the consumer's tapped out, it's all over. Be careful with that. If you take a look at the data going back, we have these 1 month anomalies where for one reason or the other you have this contraction in consumer credit, but then the next month there's a big resurgence in that usage. So I wouldn't pay a lot of attention to that data, but again, with everything that's going on, it's not surprising that consumers said, hey, I'm going to hold off here for a second on buying stuff until we kind of sort all this kind of craziness out. So we'll kind of see how that works out. But again, I wouldn't read a lot into it, but that contraction is worrisome because we are seeing personal savings rates decline. We are seeing, households having to use more credit just to make ends meet. We talked about recently the buy now, pay later thing, which is now being used to pay for food. Buy now, pay later was this idea that was invented for larger purchases, right? So I could buy something big and then pay for it on 4 equal installments. At 0% interest, supposedly, and if I didn't do that, it was 36%. They forgot to tell you that part. But now what we're seeing is people use that just to buy food. That certainly isn't what that was intended for, but again, consumers are very crafty about finding ways to make ends meet, and that's what's been going on. So that's certainly that's been helping provide support to the economy, but that is clearly starting to become more strained. So again, there are certainly signs that the economy is going to slow down and that we're going to see weaker economic growth here this year. So again, just kind of, staying kind of abreast of that. Yesterday, we saw a lot of market volatility. One thing that we saw yesterday in particular was, I got a lot of emails on this last night as well, is a very big drop in yields yesterday. A big jump in yields yesterday, a big drop in bond prices. Very outsized, very unnormal. Two things were happening yesterday that suggest that somebody may have blown up yesterday. We don't know yet. We haven't seen any of the evidence as of yet. But yesterday morning, the markets were down nearly 4.5% on the S&P. Big decline. At the same time, bond yields were jumping sharply. And then across the selling across the board, we saw at the open yesterday, companies like 3M, JP Morgan, Goldman Sachs down 5, 6, 7. 3M was down 12% yesterday morning. Now, that really isn't a reflection of tariffs because those stocks have already been under pressure. There's already been a lot of selling in those stocks up to yesterday morning. Yesterday morning was a capitulation, but it also looked like either there was a big margin call across this, because we talked about recently, we wrote an article in February about the very high levels of margin debt, and that would kind of portending to a market correction of magnitude if that margin debt started getting triggered. That looks like what happened yesterday morning, but it looked like there was a hedge fund or somebody that was forced to liquidate en masse yesterday. Now, again, I don't have any evidence of that, but that's what the action looked like yesterday morning. And then, of course, yesterday morning we had that big resurgence, and that's what we're going to talk about here on what you need to know before the bell this morning. Is yesterday's morning action was very interesting. Markets down 4.5% at the open, rallied back in minutes. We were up about 2%. We had a 5% increase in the markets in a matter of about 15 minutes on a piece of fake news headlines from Reuters saying there's going to be a 90-day pause on tariffs. Now, the reason that that's important is that shows you just how oversold the market is. The market is looking for any piece of good news here to rally. So anything that is positive from here on out, likely going to see a fairly big rally in the markets. And again, that's something that you should kind of expect here. Again, futures are pointing up this morning. We'll see if they hold here into the trading day. But interestingly enough, this is a weekly chart of the S&P 500 going back 10 years. This red line at the bottom is the 200-week moving average, which has been running support for the market over the last decade. Every time the market has come down to this level, it has rebounded sharply off that, and that has basically marked the bottoms of like the 2022 kind of correctional period we saw. During that period, market came down, tested that 200-week moving average, held that, started rallying back up. In 2020, we cracked it temporarily. But again, the Fed was stepping in, and of course we'd shut down the economy, but that recovered very quickly back above that. 2018 during that sell-off held there all the way back through history. That 200-day moving average has been good, strong support for the markets going back to 2009. So again, the markets now are approaching that. We're very close to that. That's around 4660 on the S&P 500. So is lower from here. So there is potential we could get down a bit lower here in the markets. That wouldn't be surprising. We see a little bit of a rally here, kind of get some people back relieved, get some money coming back into the market. Trap longs come in, start selling, get another piece of bad news on the economy, whatever it is, come down, retest that low. That forms the bottom for this correction, and then potentially we start kind of healing up from here. But again, pay attention to this level. Markets are very oversold on a weekly basis, again, at levels that normally we haven't seen in quite some time. This depth of oversold relative strength is something that normally occurs near market bottoms of pretty significant corrections. So from a lot of standpoints, we may not be at the bottom yet, but we're starting to get close to that, and we're due for a decent rally here in the meantime. So again, as we've talked about before, this initial rally you'll want to use to rebalance portfolios, reduce some risk, raise some cash levels. Markets are going to come back down, retest some level of support. Could be that lower level. We'll see. Don't know for sure if we're going to get there. But there is a target here in the markets on a weekly basis that markets could work themselves down to. And moving averages tend to work like gravity. Markets want to try to get to those moving averages because that's just the way kind of the markets work in general. So we're going to try to push down to this level at some point. Does that happen today, tomorrow, next week? Do we get a significant rally and then another decline that later this summer? I don't know. There's so many moving variables here with the administration, with these tariffs, the kind of the tit for tat between us and China right now. There's a lot of pressure there. So again, we'll see. And of course, if there is a recession, that's certainly going to help push prices lower here in the near future. But again, I would expect, given the deep oversold conditions here, I would expect a fairly significant rally here at some point. But make sure you're using that to rebalance risk. Analyze your portfolio, what's working, what's not working, make some adjustments, because this break here is going to take some time to recover and to get back to kind of an even keel in portfolio. So we've got a lot of work to do for us. So again, you'll just kind of want to navigate this. But that's what you need to know before the bell this morning. We'll come back. I'll pick up with John Penn. Got a lot of stuff to get into, lots of questions about what's going on right now. We'll get more into all of what's happening right after the break on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So lots of stuff going on with tariffs, still, and this is going to be a while as we sort through this. There's not going to be a quick resolution into this. China came back yesterday and said, well, if you're going to put a 50% tariff on me, then we're going to retaliate some more, and we're not going to submit ourselves to blackmail. So they're being pretty, they've got a pretty hardline stance against the Trump administration right now in terms of their tariffs. Outside of that, though, 70 other countries have now come to the table and said, yeah, we're willing to negotiate. As we talked about before, China is a little bit of a different animal. And I wrote about this in this weekend's newsletter, is that President Xi has to save face in this, right? So he can't be seen as being bullied into making a deal. Now, other countries don't have this kind of pride issue that China has. It's about honor. And so what President Xi needs to come to the table is that he needs a negotiation that allows him to save face. So what Trump should do in this particular case, again, I'm not President Trump, but this is, in my opinion, is that you instituted these tariffs and they counter-responded. This is just the point to say, okay, hey, instead of retaliating and going up another 50% and raising the stakes, the door was open there saying, okay, great, you retaliated on us, we're at even. We've both got 35% tariffs on each other. Let's sit down at the table and let's talk about this. That would have been a better move than what President Trump did with the immediate retaliation, because just like President Trump said when China retaliated, he said, oh, China made a big mistake. Well, China said yesterday, oh, well, by the retaliation, he made a big mistake. This is all about honor and saving face. So, but again, other countries don't have this issue, but China's the one. Out of all the countries that we're dealing with on tariffs, China's the one, that's the nut that Trump needs to basically resolve to get the markets back on firmer footing. So again, we'll see what happens, but we're starting to get some good news. We'll see what happens. The markets are pointing higher this morning, not a lot. Markets are up about 1.5% this morning. It's not a big move this morning, but we're getting a little bit of a relief rally. That's good. If we had good news, this market would be up 3 or 4% today. but we're not there yet. And again, you still got the administration pretty much across the board, saying, hey, we're going to do these tariffs. We're going to run this through. We're not going to back off of this. This puts the economy at risk. Another mistake that has kind of been made with this is you kind of put the cart before the horse because you didn't shore up the U.S. side of the economy before instituting the tariffs. The tariffs are going to be a negative impact to the economy. You needed to, pass tax cuts, set up a situation. It takes time to reshore jobs, reshore manufacturing. It takes time for companies just can't flip a switch and move all my shoe production from Vietnam back to the U.S., right? You need to set up the pathway for that, set up the support for that, then you do the tariffs. The problem with doing the tariffs first is that now companies are kind of stuck because they don't have the ability to reshore things literally overnight. And so this is going to have an impact to the economy. We're going to see a lot slower economic growth. We're going to see more stress economically and financially. And that's why I was saying kind of, whatever rally we get here is likely going to be short-lived. We're probably going to retest lows soon, maybe set new lows before this is over. But we'll get there to a point. There is going to be a point that we're going to get to the end of this corrective cycle. Markets will begin to realign themselves with a new outlook for earnings, new valuations. We're good with this, and then money will start to come back into the market. We've had the largest amount of selling on record, period, end of story, right? I mean, just a tremendous amount of selling and liquidations. We've seen margin get liquidated here. We've seen, really just kind of panic selling across the board. This is generally a place where markets start to find bottoms. The reason I'm telling you all this is because there's two camps in the markets right now. There is the sell and get me out of everything and I'm done with the markets. And there's surprisingly a very large constituent of individuals I've been talking to lately that are like, it's a time to buy.
Yeah, they're excited.
Yeah.
It's like they've been waiting for an opportunity for equities, just for, to be at better or more attractive valuations, right? And they've been waiting, and now here the opportunity is presenting itself, right? And so, there are many folks. The same thing with me over the last week. It's kind of been folks are in two camps. It's either, hey, I'm scared to death, or hey, I'm pretty excited here. When are we putting some money to work?
Right.
And
that's going to be the $64 million question.
It is,
right?
Yeah.
So, and again, it's a very interesting situation that you're in because, again, for me, I've got no problem just buying here.
Yeah.
Right. But then we have to manage the psychology of clients as well.
Well, and you're talking about the psychology a little bit. So, I think something that I've been trying to help people do over the last, week, it's all kind of blending together at this point, is just trying to take a kind of a frame of reference with all of this. Because when you look at what markets have done this year, through the end of last week, the S&P is down about 13.5%. NASDAQ's down about 17% for the year. Those are more, serious moves for the market as of late, right?
Yep.
But if you have a diversified portfolio, if you just don't own all just growth stocks in your portfolio, if you have value stocks in there, if you have bonds in the portfolio, there are areas of the market this year that are helping you weather this market volatility really well. So, you see all the headlines where the markets are getting crushed. I know the headlines are in your face every day, but if you could just take a step back and focus on how is your specific portfolio performing, yes, just recently, maybe your portfolio just turned negative within the last week, but for the most part, you've been kind of holding your own up to this point. So compared to what's going on out there right now, you're actually doing pretty well.
Yeah.
Right.
Well, and again, we have to, one of the big mistakes, we've talked about this before.
Yeah.
The biggest mistake that investors make is they measure off the high water mark, right? I got this text earlier this week. My portfolio is down, X amount of dollars from the peak, right? The price that the price of admission to investing in the markets and making money over time is volatility, which means that things do go up, but things also come down. And, it's always interesting because we know inherently that we should buy declines, but when we're actually in the decline, the last thing you want to do is buy anything.
Yeah. It's like you should do the opposite of what you're feeling.
Right.
Right.
Which is, it's hard.
It is hard.
It's very hard.
So, but it's like, it's the sentiment, I think, Lance. Like, so in general, the folks that I've been visiting with, their portfolios are down somewhere between 2 to 4, maybe 5% if they have a little bit more equity exposure. Mm-hmm. But the sentiment, they feel like they're down 20 to 50%. I mean, the sentiment is, oh my gosh, we're going through another 2007, 2008. Right. And I'm just like, okay. And what I'm finding is, it's very interesting that when markets are up, when we have positive years as investors, we tend to minimize our gains. Well, I was only up 10% last year.
Yeah.
I was only up 8% last year. Well, I was only up 13 last year. Okay. But then this year, it's like my too many of my calls are starting out saying, I'm already down X amount of dollars. I'm down dollars. Okay. Yeah. Well, we try to minimize our movements up, and we try to really maximize or exaggerate the downward, what we see. And it's like, well, okay, yeah, so you're down in this amount of dollars, but translate that to what percent of that is the portfolio? And of that downward draft that you see in your portfolio, how much of that has been a withdrawal that you've used to buy a car, or remodel your kitchen since we last visited? It's not all market movement.
Right. Well, that is very much the interesting thing is that, this is another big mistake that I run into with clients in particular, but prospects also, and just people I talk to in general. How'd your portfolio do last year? Oh, market was up 20. I was only up 12.
Yeah.
Right. And I've used this example on the show before. Like I'm going to buy Mercedes for Brent for his bonus this year, and he's all happy, right? So look, fist up in the air.
Man.
He's convertible. Yeah. Absolutely. Replace that 1929 Mazda you have. But I'm going to buy you two Mercedes this year.
That Mazda will outlast the Mercedes, by the way.
Yeah, exactly. So, but now Brent's upset because he only got one Mercedes and because somebody else got two.
Yeah.
Right? So we're always upset that we didn't perform as much as the market. Well, here's the thing. If you want the 20% gains in the market, you've got to be willing to accept the 10% declines. But we don't want to.
Yeah.
We want all the upside and none of the downside risk. And I'm sorry, that's just not the way markets work.
That's right.
Right? You've got to be willing to. Now, if you're willing to give up some of the gains, if you're willing to be happy with a Mercedes versus two, then you can absolutely minimize those downside draws.
Sure.
And you'll actually wind up performing better over time by doing that. But again, there's no free lunch. You're going to have to give up something. If you want less volatility in your portfolio, you've got to give up volatility in your portfolio. So that means you give up the gains, some of the gains, not all of them, but you've got to be happy with, and this is the point of that article. I may have to rewrite this article at some point because I think it's becoming relevant. But the point of that article was you've got to learn to be happy when enough is enough. Are you reaching your goals? Are you moving towards your goals? And then during these declines, these periods, are these survivable declines? Or you're going to decline in the market. There's no way to avoid that. But can you do that and survive it in a good position? That's the real question. All right, we'll come back. Got a lot of stuff to get into this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum income or pension annuity, retirement plan rollover, or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife is not a basketball fan. She never watches basketball. She doesn't understand basketball. She pays no attention to basketball at all. So she knows nothing about basketball.
The Real Investment Show podcast.
But her office had a March Madness pool on who would win March Madness. She goes, nah, I'm not doing that. Just do it. You might win some money out of it, right? And so she's like, fine. So she fills out a bracket. Well, they came to her yesterday. She's number one. She picked Duke.
At realinvestmentadvice.com.
This is the epitome of a blind squirrel finds a nut every now and then, because I don't even know if she knows who Duke is, my basketball phenom that I live with.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
One of the things that we've talked about in the past is that there's anything you need to be watching in the markets to know whether or not you're about to enter the next great, kind of financial crisis or, major market downturn is credit spreads. There's a lot of credit spreads to look at. So just real quick, what's a credit spread? A credit spread is the difference between yields of different maturities. You can look at corporate credit spread. So you can look at, for instance, the spread between an A-rated corporate bond and a double B-rated corporate bond, right? And that the difference in that yield is the spread. So if the corporate the A-rated corporate bond has a yield of 1% and the double B has a yield of 2%, your spread is 1%, right? Just 2 minus 1. It's pretty easy. You can also look at risk-free versus non-risk-free spreads. So U.S. Treasury bond versus a double B junk bond, or A-rated bond versus a investment-grade corporate bond. What credit spreads tell you is if there is risk or stress in the financial markets. When credit spreads are very low, investors are willing to take on more risk in the credit markets versus when they're high. So when you start seeing very, very sharp increases in spreads, that typically tells you that there is stress within the financial markets. Now, just because they're going up a little bit, you have to put these into context of longer term periods. And yes, credit spreads are rising here as of late, which you would expect when you're just having liquidation of assets really kind of across the board going on right now, which we have going on. I mean, we just have mass dumping of equities and bonds and everything else right now. So you're going to get some spread increase in those yields when you have that type of action going on. But is it at levels that have historically denoted larger financial crises that we've seen previously? And that answer is no, not yet. Doesn't mean we won't get there. But credit spreads are still low relative to history. In other words, people are still willing to not really get paid for the risk they take buying a junk bond over buying a risk-free treasury. We were just a good example. Mike and I were just looking at, we had a client call in and said, hey, I'd really like to buy some muni bonds here for the tax-free, issues. And when you're buying bonds, you want to buy a muni because I get tax-free income. It sounds great, right? That's not the way you look at it, though. You look at the difference between what am I getting paid for the muni bond versus what am I getting paid for U.S. Treasury, as an example. And on an after-tax basis, what am I getting paid more for? And if I can have a risk-free treasury and get paid the same as buying a tax-free muni on an after-tax basis, I might as well do that and just eliminate the municipality risk entirely. Now, munis have a very low default rate, but it's still the point. You're not getting paid for the additional risk. And that was as of the case of just a couple of days ago. We were doing this exercise. So again, just not really getting paid for that right now. Now, it doesn't mean we won't, but again, when you're looking at credit spreads as a stress indicator of the financial system, which is what we're talking about. We're not talking about stocks, right? We're talking about, is there risk to the financial system itself like we saw in 2008 or like we saw during the pandemic, where you had very big jumps in spreads and basically a decline in yields in the 10-year Treasury? No, we don't have that yet. Right. So again, we're watching that very carefully, but that's something to pay attention to. In fact, one of the things we're doing on Simple Advisors, we're building out a whole credit spread page here in the future. So we'll have that. So you can just actually go there and just look at all the credit spreads. But, this is one of the things that we're starting to get a lot of questions about, because you're seeing a lot of this in the media and they're showing this massive jump in credit spreads. Well, the problem is they're taking a very short window of that time frame, like over the last 3 months. And yeah, if you look at that picture, it looks like this huge, massive jump. But if you zoom out over the last 5-10 years, it barely shows up. So again, you got to be careful. Look, a lot of them, as we talked about before, the media wants to scare the bejeebers out of you because it gets you headlines, it gets you narratives, those type of things, gets clicks and views. But make sure you analyze the data the right way.
So you mean the media is making something more than what it might really be?
Well, everybody wants clicks and views, right?
Oh.
Right. So, if I wanted a lot of views on the show, right, we say market crashes, right? Markets, we start getting red banners. Markets in turmoil. We start running the CNBC banners.
It's getting crushed.
Exactly. There's all these great headlines, right? But that's going to get a lot of clicks and views because, people have a tendency to want to watch train wrecks. By the way, have you seen 1923 yet?
Yes.
Right.
Yes,
I have a major beef with 1923 on multiple levels, because the stuff that was happening in that show would not happen to normal people ever, even the worst. Like, for instance, a whole ghost ship episode, right? He's in a boat. There's this ghost ship that's just floating in the ocean. They pass it. And then somehow 3 days later, they run back into it. So what, was he just going in circles for 3 days? But this guy knows how to drive a boat. So
spoiler alert.
So lots of issues with that.
Well, so we were watching that too. So we caught the finale. We watched it Sunday.
Yes,
and as we were going through it, and Shauna and my wife, the love of my life, I'm just putting that out there. We're watching the show, and it's like, wow, this is so exaggerated. I can't believe there's no way that this would happen in real life. This Taylor Sheridan boy, he sure does, like he exaggerates it. I'm just like, just watch it for what it's worth. Just let me enjoy the entertainment value of this. Well, this would never happen. And I know this wouldn't happen in real life. I'm just trying to watch it. It's just interesting. Yeah.
It was too much. It was too much.
It was a little over, but I mean, I enjoyed it. I mean, I really did. But some of it got a little stretched, I thought.
Yeah.
But I thought it was very good.
Yeah. No, it was great, right? Very entertaining.
Yeah.
But it just at the end of it, I was very frustrated at the end of it. I was like, after all they went through, can they just be together?
Yeah.
Right? No, we can't even have that. So, anyway, I digress. Credit spreads, though. But back, this is the issue with credit spreads, right? It's the 1923 version of credit spreads, which is we got to make it so dramatic that we elicit a response, an emotional response. And that's why you've got to be really careful with data, zoom out on things, take longer looks. If you're looking at a lot of daily charts, go look at weekly charts. Puts the correction in context to a large degree. You know, you look at a real short-term chart of the market, market decline looks absolutely, devastating, right? Back it up a bit. You put this correction on a 20-year chart, it barely shows up. So again, just put things into context, and that helps you get a little bit better perception about what's going on in the markets and where we are and kind of what potentially to do next.
Yeah, and it's interesting when you're talking about the discussion that you were having with Mike about municipal bonds and looking at the risk reward of maybe investing in munis or looking at treasuries. I think sometimes folks if you don't know this already, but the bond market is actually quite larger than the equity market, right? It's huge. Mm-hmm. And investing in bonds, you can invest in bonds very safely, i.e. risk-free, treasuries, or you can get more speculative in the bond market. But and you mentioned that it's rare that municipalities fail. But something that you think about if you are looking at municipal bonds, or just a bond in general, is if you had to sell that bond for some reason before it matures, how liquid is it? Is there going to be a buyer on the other side of that trade, right? Mm-hmm. So sometimes you have to look at that too, where you're like, well, the municipal bond's going to pay me this, and this is my tax-free rate of return. Here's what I'm going to get on a treasury in this particular example. But yeah, if something were to go wrong with this municipal bond, or if this doesn't work out as intended, am I going to be able to sell it? Is there going to be somebody willing to buy that bond from me? And when you buy that bond, are there enough dollars in it? Is there enough meat on the bone to attract a buyer, right? Yeah. So those are things you have to kind of think about too there.
In the chat, there was a comment saying, you never underestimate how stupid people are. True fact. And if you go to our website, realinvestmentadvice.com, and type in the word stupidity in the search bar at the top, you will get an article called The 5 Laws of Human Stupidity. This was actually a study, I believe from the University of California. And it went through how stupid people. They actually did a study on human stupidity. Like, for instance, law number 1: always and inevitably, everyone underestimates the number of stupid individuals in circulation. And that is, and I've related this all back to the markets because, again, what investors do repeatedly is exactly the opposite of what they should do. And they make bad decisions when, they sell at lows, they buy at highs, they check their portfolio way too often. Vanguard just put out a study that showed that people that check their 401k plans on a regular basis underperform those that don't. And the reason for that is that you make bad decisions by checking your portfolio all the time. As I've told you before, like during the day, when we're managing money in the markets, I don't have CNBC on. I don't have Fox Business on. I don't have the Wall Street Journal up in front of me. I don't have, those type of things going on all day because it distracts me from just paying attention to what the portfolio is doing. And so if you just focus on the sum and the whole of the parts in your portfolio, you will perform better over time. And just sometimes as I told you before, sometimes the best thing to do nothing.
Just go take a walk.
Yeah.
Get away from it.
Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Law number 2. The probability that a certain person is stupid is independent of any other characteristic of that person. I'm telling you, go search this article up on the website. It's hysterical just to read the laws. But this was a real study from a university. Federal dollars at work. But I applied all this to investing strategy and basically understanding market psychology. And this is law number 3, which I think is the most important because in the chat they were talking about Jim Cramer and other people. And as we talked about before, these headlines, the headline risk of the market is the most crucial to making mistakes with your portfolio, particularly in times of stress like we've been in recently. Law number 3, a stupid person is a person who causes losses to another person or a group of persons while deriving no gain or even possibly incurring losses. In other words, I say stuff just to get you to take an action. And this is what happens a lot in the media. You have a lot of journalists and YouTubers and all this other type of people out there putting out these, voracious headlines. Markets crashing, it's de-dollarization, it's the end of the world as we know it, and those type of things. And they have no money invested in the markets, right? They're making their money off the clicks and the views and subscriptions and those type of things, but they're not actually managing money. They don't actually have any money invested in the markets. And so they don't care if they cause you losses because they don't have any losses themselves to take. So be really careful with, who you listen to. And look, you may or may not like Jim Cramer. And look, he says a lot of stuff that turns out not to be correct. But at least he manages an actual portfolio, right? So at least he's got skin in the game for his decisions. You may or may not like Doug Cass, but he's got money invested in the game. He was on thestreet.com for a long time as a writer, but he actually manages a hedge fund. So again, at least try to listen to people that actually have risk exposed to the markets and, can potentially suffer what the results of whatever they're promoting. And this is why, we just tell you what we're doing here, how we're navigating portfolios. And we may be right, we may be wrong. We're wrong sometimes, we're right sometimes. It's, our goal is to bat 700. If we get 70% of our calls right, we're doing fine. We're not going to get 100% of things right. And that's okay. That's part of investing, because to have a market, we have to have both, people that are right. Whenever there's a buyer and a seller, they both think they're right? And it takes a buyer and seller to make every transaction occur. So both people think they're right at the time, one of them's going to be wrong. And that happens, but that's part of managing risk, that's part of managing portfolios. And that's what we relay to you. Whether you derive value from that is up to you. I hope you do. That's our hope here. And that's why we hope you continue to tune into the show and watch, and we kind of navigate these volatile markets together to get to an end goal, which is to create better wealth for people and to navigate these periods of volatility without making massive mistakes, right? The goal is not to make a massive mistake where portfolios are down 40%, right? Those are unrecoverable losses. Our goal is to avoid that. But there's times like this where you have markets literally become unbuckled that you just kind of got to work your way through. And you're going to take some impact from it. And, and it's interesting because a lot of people are, it's like I got an email from a guy and he's like, I shorted the market. I know this guy, right? He's been short the market for like 3 years. So he finally made some money. But he spent 3 years shorting the markets and not making anything, actually losing a ton of money. And so finally, so now he's beating his chest. Hey, I shorted the market and I'm making money. Great, wonderful. What are you going to do next? Are you going to unshort the market and go long next? He won't, because I know this person, right? He's consistently bearish all the time, and he's got a very, very poor track record. But this is the moment that works. The thing with bear markets or corrections is they're very short-lived events. This will be over. And it'll be over, if it's not over today, which is not, it will be over within 18 months. This cycle that we're in, whatever it is, whether it's a recession, a non-recession, whatever it is, between today and 12 to 18 months from now, this will be over. And we will be back into the next leg of whatever bull market we're going to go into for whatever period of time. And then we may go through another one of these periods, and it may be back and forth for a while. But the bear market corrective cycles in markets, historically, going back to 1900, they're fairly short-lived. Now, you can have multiples of them in a row, right, and go nowhere for a decade. That can certainly happen. Go look at 2000 through 2013. 2 massive bear markets, 2 major bull markets in between all that, right? So again, these things will pass, and we need to make sure that when this cycle passes that we're ready for the next cycle, and vice versa. Then that cycle will end, and we'll have to be ready for the cycle after that. But that's part of navigating the portfolio. This is part of navigating the markets. We're going to be here for you during that, and then we'll figure it out from there.
Yeah, because in the near future, at some point, like Lance mentioned, we're going to get through this, right? And then we're all going to be sitting there looking back in the rearview mirror, looking at the charts going, oh, if I would have just bought there, if I just would have put some money to work right there. How many of us today look back at charts and go, God, boy, Q1 2020, what an opportunity that was.
March of 2009.
What an opportunity. Yeah. The dot-com bubble. I mean, what an opportunity that was. Well, markets are presenting an opportunity at some, like Lance mentioned, if there's a reflexive rally here, we can use it as an opportunity to maybe, raise some cash. Then if there is some additional market weakness, we can look at that as an opportunity to redeploy at maybe some, even more attractive valuations. But there are a lot of you that I've been visiting with over the last year and a half, and you've been waiting. Well, I'm just going to wait. I'm going to wait till after the election. I'm going to wait till after this. I'm going to wait till after this. Well, here's an opportunity to put some money to work. That doesn't mean you have to go all in, but maybe you start to nibble here because we're gonna get through this, and we're gonna look back and go, God, John, how many times have I told you, I wish I would have put money to work here. I wish I would have put money to work here. I wish I would have done this. Well, right now, the market's giving you an opportunity. Again, that's not saying you have to go all in. It doesn't have to be all or nothing. But so many of you that I've visited with, you've been keeping your money in the money market. That's okay. You've been getting 4% risk-free. Well, chances are by the end of the year, that money market probably won't be paying 4% anymore. So you got to make a decision. Are you going to kind of stay where you are, or is it time to maybe to start put a little bit of money to work? Because a lot of you that I've been visiting with who have been concerned about the markets, you're also concerned about your money not working for you and not outpacing inflation. And sitting in the money market isn't going to do that for you. So this is where you got to start making some decisions, right?
Yeah, exactly. I mean, there's some comments in the chat about 1930, right? And, like one of them is that, I'm not saying that Lance is wrong, but, I bet they said the same thing in 1930. Well, when we were back at 1930, I didn't say the same thing in 1930. It was a little bit of a different picture back then. I mean, I know I'm old, but I'm.
Now there's a show.
Yeah. 1930s.
There it is.
I'm sure somebody will die of frostbite in that one too. So
the miraculous overnight frostbite.
Exactly.
Well, at least you didn't wind up on a door somewhere floating.
Exactly, Titanic. Yeah. There was still plenty. I still contend that there was plenty of room on that door for Jack.
Oh yeah.
She purposely just shoved him into the water.
It's my door.
That's where the old term "every man for himself" comes from. Anyway, but no, 1930 was a very different example. But you had a different set of environments back in 1930 that were a confluence of events. You didn't have FDIC insurance to bail out banks. Banks went bankrupt. People lost everything because the banks failed, right? It didn't even matter if they were invested in the markets or not. A lot of people weren't. But when the banks failed, they lost everything. And so it was a very different environment back in the 1930s. But again, if you were a buyer of assets in the 1930s, it took a while.
Yeah.
But people made a lot of money coming out of the 1930s. A lot of wealth was built. So, again, I'm not saying that this is the 1930s by any stretch of the imagination. I mean, I was young back then, but, we're going to get through this and things are going to improve, but we're not going to just immediately recover to all-time highs unless the Fed steps in, drops rates to zero, starts doing $100 billion a month in QE, that type of thing. I don't see that coming right now. There's really no need, but while credit spreads are rising, there's no real sign of financial stress. So at this point, there's no need for the Fed to just come in and start bailing out everything. We're not there, but again, that could happen, and that would potentially send markets right back to all-time highs. But X that, we're likely in for a period of slogging around, ups and downs, frustration. This is the time not to make mistakes. So be very cautious about how you navigate for right now. This will end and things will get better, but it's going to take a little bit of time. All right. Hope y'all enjoyed the show this morning. Be sure and like and subscribe to the channel. We certainly appreciate that very much. And we'll be back tomorrow with Danny Ratliff. We'll catch up with what happens in the markets today. And again, like I said, we'll just kind of work through it together. We'll get there. Have a great day.